The importance of tax planning in the late stages of retirement on this edition of WealthWise. Hi, and welcome. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, an independent financial planning and wealth advisory firm focused on giving you practical and actionable advice to move your plans forward. We hope you're enjoying this series on tax planning through the 4 stages of retirement. This month, we're walking through the 4 keys that we need to pay attention to as we're working through the 4 stages of retirement. And today, we're heading into the last of our 4 phases as we discuss late retirement, usually around age 80 to 90 and up. So we've gone from pre-retirement or work and save years, to early retirement, the go-go years, to middle retirement, the slow-go years, to finally arrive at late retirement or the no-go years. And while the term no-go years can sound sad, it's actually just a practical way to define that period of time when hopefully we've done many of the things we want to do in retirement, and then we've arrived at a period of life that can be accompanied by perhaps health issues or really slowing down. And unfortunately, it can be one of the most expensive phases of our lives as we start to incur medical expenses and long-term care expenses. Over the years, we've found that one of the primary concerns of retirees in this phase is the ability to pay for their care without burdening their family and still leave a financial legacy, hoping to be able to pass something on to their family or causes that are important to them. So how does retirement tax planning figure in? Well, the obvious answer is the less you pay in taxes, the more you have available to pay for care or pass on to your heirs or make bequests. That's why key number 4, organize your assets for your family's benefit, is important. Estate planning does still matter. So what do I mean by organizing your assets? Different types of accounts get different tax treatment. And in this example, we're going to look at what we call a step-up in basis strategy. This is a rule that treats a beneficiary as if they purchased the inherited asset on the day it was left to them. So with estate planning, our goal is to make sure that beneficiaries are designated, that accounts are titled in a way that they will pass most efficiently to our heirs, and this is a strategy to do that. So Phil and Mary, for example, they have a joint brokerage account, and the acronym used here is JTWROS. So it's a regular investment account titled Joint Tenants with Rights of Survivorship. And what that means is that when one spouse passes away, the other automatically owns the account entirely. So inside that joint investment account, Phil and Mary have $120,000 in investments with a long-term capital gain. And you'll remember from an earlier episode that long-term capital gains get favorable tax treatment. But unfortunately for Phil and Mary, Phil is diagnosed with a terminal illness, and the physicians tell him that they expect maybe he's got about 18 months to live. And as unfortunate as that situation is, Phil wants to make sure his family is taken care of when he passes. So he comes to an advisor, and Phil and Mary sit down and they go through to make sure that their estate plan is in order. So let's look at a couple of scenarios that Phil and Mary have available to maximize their assets. So scenario 1, it is just doing nothing with that joint account. Phil passes away, Mary inherits his half of the joint account, and so the step up in basis eliminates the long-term capital gain on Phil's half. When I say step up in basis, the way the estate tax law works right now is that when you inherit assets in a taxable account, you inherit those assets at the value of the date of death and you pay no tax. And so in this situation, Mary inherits Phil's half of that step up in basis. But because it's a joint account and everything is 50-50, she only gets a step up in basis on his half, not on her own. So if she sold all the investments in the account, she would owe only income tax on her gains, not on Phil's. So her gains equal long-term capital gains on her $60,000 plus any gains on the remainder after Phil's death. So the bottom line here is if she sold everything, Mary would owe tax on her $60,000 of gain. Let's look at scenario 2. After sitting down with Phil and Mary prior to Phil's death, and we think about how we can efficiently title the portfolio in a way that would transfer asset to heirs with the least tax ramifications, we decide to move all of the investments into one account in Phil's name. Unfortunately, Phil does pass away about 18 months later. But because we made that move and now all the assets were in Phil's name, Mary inherits the entire account from Phil, and the entire $120,000 steps up in basis. So Mary can pay $0 in taxes because she inherited the entire account at that value on his date of death. So thinking about how accounts are titled and when certain life situations happen, involving your advisor and making sure they're aware and doing a little tax planning at that time can really make a big difference when you're thinking about leaving a legacy and providing for your heirs long term. So just a question. When you go to sell your investment, would you rather owe tax on $60,000 in gains or no tax at all? Easy answer. I think most of us would rather owe no tax at all. Long-term care planning is something else that we really want to work on the front end, particularly in that late stage of retirement, the no-go years. So just very briefly, not to go into much depth today on long-term care, but there are lots of different ways to fund long-term care. If you decide to go with insurance, your premiums may be deductible at both the federal and state levels. The payments from those policies are tax-free to pay for the reimbursement of those long-term care expenses. And choosing how to pay for long-term care can have a big impact on your heirs. So it's certainly something that needs to be discussed and built into your long-term plan when it comes to your retirement income and your legacy planning. So to recap, in late retirement, it's really important to make sure you've thought through how to organize your assets and plan for long-term care so that you can leave the legacy that's most important to you in the most tax-efficient manner. Because your tax exposure changes over time, you need a plan to anticipate all these things and how and when you tap your assets to cover those expenses. It's important to understand that domino effect, those ranges of taxes you will face at various stages in your retirement life cycle, and manage those actions so that you pay as low a tax rate as possible. We know we're going to pay taxes. What's certain? Death and taxes, right? So we know that we're going to pay taxes on those things, but we can certainly work with each individual retiree in a situation to make sure they're aware of what's going to happen and make changes so that we can keep that tax situation as low as possible. The distribution phase is complicated and managing tax happens throughout retirement. As I just mentioned, mistakes can be costly, but most of the time we can take the mistakes and turn them into something that has a more favorable tax situation the next year, or just do a little bit better planning. So we've covered so much this series in the 4 key points for tax planning through the 4 stages of retirement. And at this point, you may be a little overwhelmed thinking, goodness, how in the world are we ever going to manage all of this? And that's what advisors like us at Elevate Wealth Advisory are here for. And it's one of the areas where we really shine. Let us help you add value to your long-term retirement planning situation. Thank you for joining us for this series on WealthWise. Please feel free to connect with us at elevate-wealth.com.